What's up, YouTube? Stocks by the numbers. Welcome back. Intel Corporation, INTC, listed here on the Nasdaq. 31 and 3/4 right now, down about 30 cents, 1% here on the day. And basically, in my opinion, overall here, I see no big urgency to own this stock here in the immediate short term. And of course, we could have our earnings pops and drops, but we're basically seeing a company that is losing market share, and it seems like, in my opinion, they were just kind of coasting off of their name recognition, right? If we go back to like the 90s, early 2000s, it was all about Intel. They were basically the main player in the processor space. Now you have companies like AMD coming up, basically putting out very, very similar products that could compete with Intel processors. And of course, they were able to do it at a much cheaper price tag to the consumer. So a lot of people started, building custom PCs, and they were going for AMD chips as opposed to Intel chips. Now, I'm not necessarily knocking their chips. I mean, I built this PC a few years ago. I have an Intel i7, but at the end of the day, not everyone is going to buy your product just because it's Intel. And now we have, Taiwan Semiconductor. Basically, I believe they have like 60% market share right now in that space. So they have a lot of competition. They have a lot of competition in their space now. And the one good thing that saved them was the CHIPS Act, which you guys may have heard of. They received like billions of dollars through the CHIPS Act to secure a domestic supply of semiconductor chips here in the States, or at least domestically here in North America. So, that could work out nicely, but we may not really see the rate of return from that for 2, 3, 4 years down the road. So if you're looking at this one and you're planning to hold it for several years, then in my opinion, it'll probably pay off for you. In the short term, I just feel like it's mixed, and it really could go either way. We recently dropped here with earnings coming out about a month ago. The company missed on the revenue side by 74.6 million, only about 0.5%. Growth is up year over year. If we look at the same time last year, 11.71 billion. The company posted 12.72 billion. So revenue up about $1 billion year over year. So a lot of these numbers are trending in the right direction. The problem with Intel is it leaves a sour taste in everyone's mouth, because usually when traders look at the numbers and they see that it is potentially attractive or undervalued, so they'll step in, they'll buy shares, they'll buy some short-term calls, and then what happens? The company just continues to sell off or happens to disappoint and then completely shits the bed. So basically, quarter over quarter, again, in my opinion, that unfortunately would be the way I would play it. In the short term, I personally wouldn't buy shares of Intel here at 31, 32. Again, we could have a potential gap fill back up to 34. This trend line is kind of, that's from the body right there, the bottom. Here, let me zoom in for you. See, I drew that basically along the bottom of the body of this candle, February 27, 23, and it's almost in line with that body right there. The next day of February 28, that was the low of the low right there, 24.73, and then we went on that big tear. So if we extend that line out, you can see that that is this line here that the stock almost came down and touched. So in my opinion, in the immediate short term, I would keep an eye on this trend line here, looking like about 29.60, maybe 29.70 over the next couple of weeks. So we have to see if it comes down to retest that. But again, in the short term, if you want to potentially play the gap fill back up to 34 or a retracement to the 20-day moving average, in my opinion, you can go for it, but you're probably going to need time. So again, there's no guarantee that, if you buy 34 calls for this Friday, that it's going to work out. So in my opinion, I would give it some time. But there's an article over here that just kind of lays out what they're going through. Legacy tech company too often compared with NVIDIA, AMD, practically have the same business model. Intel currently suffering from a long period of underinvestments. 9% year-over-year revenue growth. The reason the shares declined sharply at the start of the year was due to the weak second quarter guidance. Company expects EPS at 10 cents, revenue 13 billion, analysts expecting 25 cents, 13.6 billion. right? So we've already issued weak guidance. So now if the company comes out and posts like 12.7 billion and misses that number, they're going to get absolutely decimated, in my opinion. Probably going to get brought back to the low 20s. When you take a step back, focus on the business, you notice Intel a completely different direction, new direction, makes the stock attractive again. Causes the company to temporarily sacrifice some of its earnings. Management understood it would be difficult to catch up to competitors without establishing its own moat. Long-term bet. Company positions itself to become one player within a global duopoly shared with Taiwan Semiconductor. TSM, world's largest foundry with approximately 60% market share. It's in Taiwan. Geopolitical tensions. These tensions force the U.S. Congress Chips and Science Act. Act aims to ensure long-term supply of critical semiconductor chips that are found in all electronic devices by creating chips manufacturing facilities on U.S. soil. Intel will be the main benefactor of the CHIPS Act with up to $8.5 billion in grants and $11 billion in loans from the U.S. government. This is a much welcome boost. Help regain the edge. Break down the segment revenue here. We can see client computing is where the most revenue comes in, $7.5 billion, and that's up nicely, about 31% year over year. But the foundry itself here, we can see down to $4.4 billion. That's down 10% year over year. So this speaks about how the costs, the business will essentially rival chip manufacturer Taiwan Semiconductor. However, is also by far the most capital-intensive business segment, causing Intel to lose $7 billion in 23. Experts expect the business to break even in 2027, at which point profitability will grow from there. Therefore, any long position initiated should be held at least until 2027. Not really sure if you're allowed to say that, but either way, stock is potentially an attractive investment. Yep, we peaked in 21 and then started to drop down from there. EV to EBITDA comparison. It's been under pressure. Company may be at its turning point. The fact it does not try to directly challenge NVIDIA, AMD, or Qualcomm and instead walks away to create its own edge makes the stock highly interesting for a long-term investment within a diversified portfolio. Its financials and valuation reflect past business performance. It's worth paying attention to business strategy remodeling and consider holding shares for a period of at least 3 to 5 additional years. So, based on the investment here now into U.S. manufacturing facility, in my opinion, I would agree with that. Yeah, probably if you give this 3, 4, 5 years, yeah, it's probably going to turn around and everything's going to be great. And, I try to keep politics out of it, but remember, it's an election year. And if you remember, let's go back actually. Yeah, look at the growth from 2016 here, right? This is when Trump, where is Trump? Right here, October, November, right there. So November 7th, you can see the stock was basically where it is now. It was like 33 and change, right? We had the immediate pop up here to the high 30s of about 38.5. Then we kind of consolidated downward, bounced around this trend line, and then just started to explode and chunk up. And the reason why, if you recall, is because Trump was very obviously pro-America, and, these companies should be reinvesting into America and in American businesses. And I recall that Intel was actually like one of the first corporations to step forward and say like, oh yeah, we're investing, I don't remember the exact dollar amount, my apologies, but they said something, we're investing all 2.1 billion or whatever it was into a facility here in the States, to bring back manufacturing to America and whatnot. So obviously it was a positive response, right? And then mixed with that, since then, as you see, from 21, the stock really took a hit here. And if we pull up some of these numbers, we can see that for the most part, they were actually beating revenue going into this initial sell-off, right? And then we got mixed. Then we had big drops, big misses. And that brought us all the way down here to the low 20s. And since then, it has been mixed. Coming throughout 23 was a very strong year, and then the company comes out and misses here recently, about a month ago. So, honestly, in the immediate short term, it does seem very difficult to play. And actually, no. In the immediate short term, it does seem very difficult to play. Again, if you want to play the 34 gap fill or whatever, it's entirely your own prerogative. In my opinion, if you gave me $1 million and told me I had to invest into a tech stock, I probably wouldn't pick Intel right here in this moment, but that is just my opinion. But again, I'm sure it's going to pay off, a couple of years down the road, but this is the restructuring phase that, something like an IBM went through. And if we bring up IBM here, you can see this is when IBM basically fell off here. It was like 2013. All of a sudden, they started to lose market share. People weren't really looking for IBM products. And then all of a sudden, the stock completely drops. Well, again, this was the lockdown. We started to see the recovery here in 18 and 19, right? They were turning that corner, and it was starting to benefit them. And then, of course, everything dropped. But since then, the stock has been on the up and up, and the revenue and the demand is now starting to come back in. So now it's back in the limelight. Now people are looking at an IBM potential investment down the road. And a situation like this, oh yeah, the stock was almost at 200. Now it pulled back to the 160s, 170s. I'm going to step in and buy this dip. And, 2-3 years from now, it's going to pay off big. And the problem is, I think that like this restructuring period is where Intel is in right now. And that took something like IBM, again, that, we're talking like 6+ years. And if we look at something like Intel here, if we potentially topped out here 2020, 2021, we're in 2024. So that's what I mean. We can potentially continue to step down. We may be like here. And what are we looking at? Bottom of the screen here, you can see that's, August 2026. I mean, of course, this is just, hypothetical projection here. But if we, follow a similar path, that's what I'm saying. We may come down. It may be early, mid, late 26 going into 27 before the company finds the bottom and actually starts bringing back in the revenue that it used to. If we look at some of the metrics here, a lot of them have started to head in the right direction, but I do see some potential red flags, including, first of all, again, they had to cut their dividend in half. We can see the debt has been climbing over the years. If we look quarterly, we can see this time last year, 50.25 billion in debt. Now we're up to 52.5 billion. But something like the free cash flow, minus 9.2 billion, now it's minus 7.2 billion. The cash has been going down as well, 8.23 billion up to 835, and then down to 7.6, 708, 6.92 billion. So this is what I mean. Right now, in the moment, the company does appear to be struggling a little bit. And right now, I don't know if I personally see any urgency to own this situation. But assets have grown up here to the 190 plus billion mark. Liabilities basically staying in line here with the low 80 billions. Assets minus liabilities yields equity. We can see the equity has for the most part been, minus that dip, has for the most part been consistently increasing, now up to 110.76 billion. Book value per share was up to 24.5, drops to 23.5, and then has been, for the most part, consistently increasing. Slight dip of 8 cents there quarter over quarter, but book value back up to almost 25 a share. Stock right now 31.75. And that's the problem with Intel. That's why a lot of people are pissed off at it. Because they'll look at, the revenue they're bringing in, and then they'll look at the market cap, and they'll potentially say it's undervalued. Or at the time, like AMD started to rally from the 50s into the 60s and the 70s and the 80s. That was because they were seeing increased demand. They were consistently coming out with new products. Intel was losing market share. But the whole time, Intel had a PE of like 10, 11, 12, right? So a lot of people may have pulled up the fundamentals and just simply thought that it was undervalued and it would, have a nice recovery, and it just never happened. Or, it would start rallying a little bit. They'd see 6, 7, 8% rally, and then we'd go into earnings and they would completely miss by a mile and the stock would tank. I'm talking years ago, of course, in the beginning of the downtrend. But The problem is we look at something like the PE here at 33. I mean, I guess we could say that's potentially fair valued for a tech stock, so we don't have to go much higher. Price to sales 2.5. I mean, again, we were higher, but before that we were lower, down here in the ones, so we could always continue to sell off. Price to cash flow, same thing, 11.33. We were higher, but 2023 they were consistently beating earnings, right? 22 was more mixed, and you can see we were down 7-8 times cash flow. Now we're still at 11, so we can continue to potentially sell off. You understand? Here, the price to book, 1.3 times book. We were up here, 1.5, 2 times book, right? But before that, we were basically in line with book value, which is now, 24.89 or whatever it is. So that's why I'm saying we can potentially still see like a 20% sell-off, and we could potentially pull back to the mid to low 20s if the company does report another rough quarter moving forward, which they might because they already issued weak guidance moving forward. Enterprise value, surprisingly enough, is up here at $172.5 billion, which is about 30% higher than the current value of the market cap right now. The return on assets went from positive to negative. Now we're slightly back positive. Same thing with the return on equity and the return on invested capital. Something like the gross margin percentage. See, a lot of people will look at this and say, wow, it was 42, 45, now it's down to 41, right? Isn't that bad? Well, technically, it is a negative, right? Because it went down quarter over quarter. But if you compare it to where they were a year ago, gross margin 34%, now it's at 41%. So that's what I mean. A lot of these metrics are moving in the right direction, which is why I say in the longer term, I'm sure it'll pay off. I'm sure the stock will eventually get back to the 40s and the 50s, and you'll make some decent percentage gains. But in the short term, you're probably going to be dealing with a lot of pops and drops. And something like the operating margin, again, moving in the right direction, it looks like back positive. Just went negative, but this time last year, minus 12%. Now it's minus 5.6%. EBITDA, 8.2% this time last year. Technically down quarter over quarter, but now we're at 14.3%. Net margin percentage as well, minus 23.5%. Now we're only minus 3%. So a lot of these numbers are trending in the right direction. So again, I can't completely bash the company, but what I'm looking at also is, first of all, the EPS seems to be solid, right? We have 5 beats in a row, 6 beats in the last 8 quarters. So in my opinion, it is the revenue. I feel like everyone is just watching the revenue. And if the revenue comes in light, the stock is going to get decimated because people will instantly translate that to you're struggling to regain your market share that you lost, right? If the demand was there, if your products were that good, your revenue would be rebounding, you'd be beating earnings. So that's why we ran so much off of these 4 beats, and then we took such a hit going into and after missing on the revenue side. And now again, it was supposed to be 13.6 billion, now it's 13 billion. So if they come in again and they post like 12.85 billion, if they miss that number again, that's why I'm saying you will more than likely see $25, $24 a share again, in my opinion. But also, if we look at the annual forecast, you can see we ran all the way up here to almost 78 billion and then started chipping down here to the 50s. And we can see for 24, we're only looking at less than 56 billion. 62 billion, 68 billion in 26, potentially back down to 66 and 2/3 in 27. So even if we give this 2, 3, 4 years, we may potentially not even get back to that 70 billion milestone mark that we hit all the way back in 2018. And remember, prices are up 30, 40% over these years. Probably more, honestly. But you understand my point. So that's why right here in the moment, I'm not exactly sure if I personally see urgency. Cloud computing segment took a hit. Data center AI took a hit, right? Their network and their edge is struggling. Mobileye actually sees consistent increases, really, it seems like, year over year. So that's what I mean. Even when we went back and looked at that graphic in that article, there are some positives in this company here. Let me pull that chart back up. There are some positives potentially in this company. right? Client computing up 31% year over year. Data center has actually started to make a recovery now, right? Up 5% year over year. But you have the network and the edge down still 8%. The foundry down 10%. Altera down 58%. And now apparently Mobileye started to soften as well. So again, the reinvestment into America and, ensuring that we have a domestic producer of these semiconductor chips and whatnot, totally understandable. And that's why, again, in the long term, I agree. I see it. In the short term, I just feel like it's too hard to call. And if you are looking for a rebound, again, a potential gap fill after earnings, in my opinion, I would buy time. I would buy at least a month or so. But we can always reject and come lower. If we look here on the weekly, we have a support level here, a resistance level now of 32.49, and we can see the stock hit 32.42 and then started to pull back a little bit. RSI dropped to that 30 mark, had a little bit of a little revival bump here, back up to about 35, now potentially flattening out. MACD looks like it wanted to start to curl, but I have a feeling it's going to continue to slide. That's just my opinion, though. And that's why, again, here in the short term, you want to play the 34 gap fill. It's entirely your own prerogative, but the stock can potentially just kind of stay in this consolidation channel. And then if they miss earnings again, we may potentially see that 25 and a third mark, potentially, in my opinion. But the MACD has been slowly climbing over about the last 2 weeks. RSI, again, people always try to talk to me about the RSI, and I respect all viewpoints. And I always try to learn new things, but, just basically, just to blindly trade or swing off of a low or a high RSI doesn't always work out. As you see here, the RSI kept well below that 30 benchmark for basically 2 weeks straight. And a lot of people on this first, day or two dip may have stepped in thinking that the calls would immediately pay off for them. And we can see that the stock kind of remained flat for a while and just recently started gaining a little momentum, but only got slightly higher than where the stock was on the initial drop. So even if you did step in on calls, you're probably not up too much, which is why I always say you can't just look at one indicator, in my opinion. But the RSI was really beaten up. Looks like it came down to about 20. And now it's back up here, sitting above 41. So this is why I'm saying we can potentially just channel here. But in my opinion, this is absolutely more of a longer term play than a shorter term play. And I'm sure you guys can understand that. And again, if we speak about potential, because I know it's an election year again, so I know we speak about potential like political trades to take. And I told you guys back in 2016 when Trump was about to win in October, like a couple of weeks before elections, I bought way out of the money calls out till like February or March on U.S. steel. Right, because Trump was very adamant about that, right? Oh, we're such a great country, and we have, our bridges, our infrastructure's falling apart. So I'm gonna make it my business to reinvest into America, rebuild our infrastructure. So what does that mean? That means, we're gonna need cement and steel. We're gonna need materials, right? So that's why I felt it was a no-brainer. Those options, again, not to pat myself on the back, we all have our war stories about our biggest gains and our biggest losses, but those options ended up yielding like 2,200, 2,400% gains, right? Just because I played the political trade off of the policy that he was saying he was going to implement, right? So sometimes it's very clear cut, right? Where it's crystal clear, it's black and white. Okay, he's saying infrastructure, that means steel, we buy U.S. steel. Okay, fine. But we know that, again, we showed the rally up throughout 2016 after Trump got elected. And then we had Intel come out and say they were, reinvesting into a facility here in the States. So, in my opinion, if you potentially want to wait till maybe like September, October, 3-4 months, actually that'd be like 4 or 5 months, but my apologies. But, if you want to wait a couple of months and then potentially step in on a dip, buy some shares to hold throughout that rally after elections, if Trump wins, Or if you want to, like I did with the calls, if you want to step in like September and you want to buy like March, like 40 calls on Intel or something, you understand what I'm saying? Then I can appreciate that you're taking like that policy trade. But if we're talking overall in general, again, I still have to say, in my opinion, I feel like Intel is currently in the multi-year restructuring phase that we saw with IBM. And I think it may not be until like this time next year or 18 months from now, the end of 25, before it really starts to pay dividends when it comes to rising value in Intel stock. So, in the immediate short term, again, if you're looking for a trade, you want a gap fill to 34. In my opinion, I'd keep an eye on 31.31 right here, this mid-Bollinger Band. We recently popped up above it, and it looks like it bounced off of it and is trying to stay above it. So in my opinion, I would keep an eye on that mid-Bollinger Band. If it retests, in my eyes, wouldn't be a big deal. If it breaks it, it might go back down to 30, potentially sub 30. So you may potentially want to, just cut your losses and move on. If I was to play those calls, though, again, I would personally probably buy at least like a month time. I wouldn't play like weekly calls, in my opinion. And also this trend line, again, I feel like we have to keep an eye on this trend line. Again, going back to the bottom of the body, February 27th, 23, and cutting across, you can see it came very close to that line, and then it had a bounce. So the line may not be perfect, right? But in general, I'm sure you can appreciate where I'm going here. And again, maybe like 29.60, 29.70 over the next couple of weeks. If it starts to approach that level, I would say, in my opinion, you have to keep an eye on that trend line, because potentially the next drop down could be to the low 20s. And it may not drop that low, right? It may come back down to like here at like 26.5, where it kind of topped out here and pause there before taking the next leg lower, right? So that may be the next level to watch, maybe like a 26.5. But basically the point is, technically right now, in the immediate short term, in the moment, in my opinion, I just feel like everything on Intel is mixed. And there's not necessarily any big catalyst or any urgency to force the stock up or to force it down. And again, we can see that a lot of analysts are mixed here. I mean, we have 45 analysts currently covering Intel, and 30 of them, right, roughly 75%, 30 of them are simply holding. 9 are giving it a strong buy, 2 still giving it a buy, 4 giving it a strong sell. Not a sell, a strong sell. So this is what I mean. Wall Street right now in the moment is mixed. And we may see a situation where, again, next quarter guidance was light, so they might miss. Boom, the stock drops to 26, 25. And then 3 months later, they might beat earnings. Boom, the stock comes back up to 32. Then maybe they beat earnings again. The stock goes up to 37. And then Q1 of 25, maybe they miss earnings and it drops back down to 31. Like, you know what I'm saying? So we may be in just this kind of like seesaw, little up and down, little trend over the course of the next 12 to 24 months. And what that means is, again, if you are a trader and you want to trade the stock on the pops and the drops, or you want to trade the beats or the misses going into earnings, entirely your own prerogative. If you are looking, in my opinion, to invest into NVIDIA, I don't know, I might actually wait, to tell you the truth. I might actually wait. Markets are still pretty high. In my opinion, markets really should be selling off. We shouldn't be maintaining these highs here. Also, again, earnings coming up end of July, and they already issued a weak forecast. So, you don't want to you don't want to go in too heavy here at 31, 32, and then all of a sudden the stock's at 25 when they miss earnings potentially in about 2 months, right? So again, if you wanted to potentially begin building a position because you feel it can get back to 45, 50 over the next couple of years, very understandable. But again, that's why I lean towards the piecing in strategy, because if you wake up 2-3 months from now and the stock's at 25, 24, you don't want to be too upset that you're down 25%. You want to be excited that, hey, listen, they're still struggling, but I'm able to buy shares at a cheaper price and bring my average down, and you watch 3 years from now, it's going to pay off, right? So that's what I mean. If you're in the financial situation to implement that kind of strategy, then by all means, go for it. And again, if you want to try to time some pops and drops in the short term with options, it's entirely your own prerogative. But in my opinion right now, I really see no urgency to step in and take a position in Intel. And unfortunately, I just have to call it like I see it. And that's pretty much it. So I'm going to end it there. Once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they're very uncertain. We were green, then we went slightly red, now we're back green again. So believe me, I understand it's extremely stressful out there, but I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Enjoy the rest of your day.